In my opinion, moving averages are one of the most important indicators you can have on your chart. In fact, if you were to trade with nothing but price and volume and moving averages, I think you could have fantastic results in trading. The problem is, a lot of new traders use moving averages incorrectly. There's a lot of misconceptions out there about how you're supposed to be using them and how you use them to enter and exit trades. So in this video, I'm going to go over what moving averages are, which ones you should probably use, how not to use them, and then finally, the correct way to use the moving averages. So stick around after the intro, and hopefully this video will improve your trading success. All right, so let's start off with, what are moving averages? Well, basically, they are exactly what the name says. It's a moving average over whatever period you define for a particular stock. So most traders will use moving averages, either an 8-day, a 10-day, a 20, a 21, a 50, a 100, or a 200-day. Those are probably some of the most common time frames. So you're probably going to ask next, well, which one should I use? Which is the best one to use? It's a difficult question to answer because it really depends on two things. One, it depends on your trading style and your time frame. So it depends on, are you a short-term swing trader or are you a long-term investor? That'll help determine which moving averages are best to use for your particular trading style. The other thing that has a big impact is the particular stock that you're trading. So for example, if you were to put all these moving averages on one chart, whichever chart you're planning on trading, and if you were to scroll back in time and just look at some of the historical data, you see pretty quickly which moving averages apply best to that particular ticker, and also to the particular time frame you're looking at, depending if you're looking at a weekly chart, a daily chart, an hourly chart, or a 1-minute chart. So when you put all those moving averages on, it really gives you a good idea visually. Very quickly, you can see which moving averages work the best. So next, let me go over how I set my moving averages up. And again, I'm not saying this is the right way to do it. This is just a way that I found works best for me. You can try it, you can, tweak it to what works for you. I just wanted to show you how I set up my charts. So for short-term indicators, so for swing type trades, I like to use the 8-day and the 21-day. I find that these just give me the best indicators for entering and exiting a trade. Now, for these short-term indicators, I want them to be very responsive. So in other words, if the stock price has a big move one day, I want this moving average to show that big move. And the way to do that is you use what's called an exponential moving average. So for the 8 and the 21, I use exponential moving averages. And what that does is it gives a higher weighting to days that are closer to the current day than days that are farther back in time. So in other words, if you're looking at a 21-day exponential moving average, it gives higher weighting to say, day 1, 2, 3, 4, 5, back from the current day than it would to, 18, 19, or 20 days back in time. So what that does is if a stock has a big move one day, it'll have a bigger impact on the moving average. Now for the other two moving averages I use, they give me more of a medium to longer term trend of where the stock is headed. I like to use the 50-day and the 200-day moving average. Now for those ones, it's kind of the opposite of what I just explained. I don't want those to be affected by big, one-day moves in the stock price. I want those to show me kind of an overall trend over that period of time. So for those ones, I use a simple moving average. And so for example, a 50-day simple moving average will give equal weighting to every day within that 50-day period. Every day is worth the same, and it just gives you the average over those last 50 days. So hopefully that makes sense. Now let's look at some charts and we'll see how to put this into application. All right, so here we got ticker SU, Suncor Energy. So I guess first let me explain how I have my moving averages set up. So like I mentioned, I have the 8-day exponential moving average. So that's this purple line. I have the 21-day exponential. That's the blue line. I have a 50-day simple moving average is my red line. And my 200-day simple moving average is the green line. So first I want to show you an example of probably one of the biggest misconceptions about how to use moving averages. I'm sure probably most of you had heard the terms golden cross and death cross. Basically, it just means where a shorter term moving average crosses above or below a longer term moving average. So in this example, we have the 50-day moving average crossing down below the 200-day moving average. So that would be considered a death cross. Well, if we look at this example, if you were to use the death cross as a sell signal, what you can see is, pretty clearly is that it would tell you to sell pretty much right at the bottom. You got to remember, moving averages are a lagging indicator. So they're not predicting what the future move of the stock is going to be. They're showing you what the past move of the stock has already happened. So in this case, the stock had a fairly big decline. Let's see, this move was about, right down to the bottom, about a 30% decline. And it wasn't until right at the bottom where you get this death cross. So if you were to use the death cross as a sell signal, you'd be selling, right around these days here, only to have the stock turn around, a week later and make a really nice rally. So you'd be selling at the worst possible time. Now, conversely, if you were to look at a cross of the 50 back above the 200, what happens right here. So here's your golden cross. Again, you would be buying at the worst possible time. You'd be buying, after this huge rally up, this move, let's say even if we count from the breakout to the top, it's a move of about 34%. And if you waited for this golden cross to appear, you'd be buying right at the top of that, only to have the stock reverse against you over the next few days. And this, I think, is probably one of the biggest mistakes new traders make. There's a lot of online information out there that says, watch for golden crosses. That's where you buy, or, sell at a death cross. But it's way too late to be using those as indicators for buying or selling. Now, that doesn't mean you shouldn't pay attention to them at all. They are important to know. For example, when you get a golden cross like this, basically it's telling you that now the stock is in an uptrend. Now, that doesn't mean that this is a buy signal and that you buy it on this day. What it means is that you want to keep an eye on this stock now. So this is a stock that's in an uptrend. It's a potential candidate for a buy, but you got to be patient and wait for the perfect entry. So you want to watch the stock and wait for the correct entry and then get into it. You don't want to use this as an entry signal. You want to use it as a signal of an uptrending stock that you want to keep an eye on. All right, so now let's go to mistake number 2. Another common misconception is just because the price of a stock pulls back to a moving average, that it's going to bounce from there. Now, that's not always the case. It may happen, but it may not. So let me show you a few examples of why that is not a good way to use the moving averages. We can actually stay with this ticker, and if I just scroll back here a little bit in time, you can actually find some really good examples. So this is the first one here. The stock had a nice rally, and then it starts to pull back a little, consolidate, and it starts moving towards these moving averages, towards the 50-day moving average. Now, if we zoom in even a little further, right into this area here, you can see on this day here, as it's getting close to the 50-day moving average, it actually gives you a pretty nice indication here on this gray day that it's going to bounce off of that 50-day moving average. Now, a common mistake that new traders make is they would see this candle and they would think, okay, well, we're at the 50-day, we got a little bounce, so I'm going to get in. Well, the problem with that is there's no confirmation yet that the bounce is actually going to happen. Just because you have one day where, and really, this isn't even a green candle. It closed flat with the previous day's close. So this really doesn't tell you enough information yet to start a position. And you can see that if you were to buy it on this day, you would immediately be underwater the next day, and you'd probably even get stopped out on this day, only to have the stock reverse and then rally without you. Similarly, if we just move over a little further ahead in time, we can see an even worse case scenario play out over here. So let me just zoom out a little bit on this one. So we can see here again, the stock was in a really nice rally. It starts to move sideways, starts to consolidate, and it's giving you the impression that it's going to bounce off the 50. You get this pullback here that doesn't quite make it to the 50. Another pullback, again, a little bit closer to the 50. And here you get a couple days where, this one is just a bounce off the 50. Here the wick is below, but it closes above the 50. Again, giving you an indication that, look, we're going to bounce from here. This is a strong area of support, and we're going to bounce off the 50-day moving average. But again, if you were to buy it on this day, even if you bought it at the close, you can see immediately the next day, the stock turns against you. And this time it actually has a pretty strong move to the downside. So the lesson from here is that if you see a bounce off of a moving average, you really need to wait for confirmation before getting into the trade. So for example, in this case here, if instead of this red bar, after this candle, if we had a nice green candle that actually took out the high of the previous day and moved up off of a moving average, that would be your confirmation that the trade is probably going to work, or at least that you have a good probability of success in that trade. But you definitely need to wait for that confirmation before getting into a trade. All right, so now you know what not to do with the moving averages. What is the correct way to use them? So let me show you a few examples, and again, we'll stay on the same chart, stay on Suncor. I'll just scroll back a little further in time again. So first I'll show you two methods, but first I'll show you my favorite method, or my favorite way to use the moving averages. And that is to determine what the short and medium term trend is, and also as a measure of volatility. So if we look at this example here, this was from late 2020, early 2021. You can see the stock had a really nice rally, had a nice move up from these lows of, about a 58% move. So a really nice rally, and then started to move sideways and consolidate. Now, hopefully most of you know that stocks move in cycles. And what I mean by cycles is volatility cycles. So a stock that's had a high volatility move will enter a period of low volatility. And then after that period of low volatility, we'll enter another period of high volatility. Now, you don't know which direction that's going to happen in yet. So just because the stock is consolidating and moving sideways doesn't necessarily mean there'll be another move up. This next move of high volatility could have just as easily been down as up. So you need to wait for confirmation to see the direction. But one thing to note is that whenever you have an area like this of low volatility, an area of high volatility is about to follow. So the way I use the moving averages is that when you see something like this, where the moving averages are as closely aligned as possible, the closer they are, the better. So in this case, you have the 8, the 21, and the 50. They're all touching. And what's really nice about this is they're all above the 200-day moving average. So whenever I see something like this, you want to keep an eye on this and then just get ready for the perfect entry. So in this case, there's a couple ways you could have traded this. The first one, so you can see over the last several days, the price keeps testing the bottom side of the moving averages. On this day, it actually does get above, but immediately gets rejected and still close below. So none of those are buy entries. On this day here, it's the first day where you actually get a close above the moving average. Now, the problem with this day, it did have a nice volume spike. So that was what was good about it, but it hasn't made a new high yet. So you can see that, it's still lower than this previous high over here. So it's really not a great entry yet. Now, the next day, here you get a more decisive close. Now it's clearly above the moving averages, and it has made a new high over this, this last 1 week consolidation period. So if we look at the volume on this day, you can see that it's just slightly above average. So that's good. I would have liked to see maybe a little bit higher volume, but at least we have slightly above average volume and a nice close, a nice strong close towards the high of the day, higher than the previous days and above the moving averages. So this would be a good day to start a position. Now, would I open a full position on this day? Probably not. If the volume had been a little higher, I probably would be inclined to be a little more aggressive. But on a candle like this, I'd probably open up, say maybe half of a position of what I would like to own in the stock. Now you could, if you want to be aggressive, this could be a candle where you could justify, going into a full position. But for my strategy, typically I'd buy about a half position on this day and then watch the stock, continue to watch it to see where it moves next. So assuming you did that, the next day you can see you get a nice move up again, and then a little pullback down to the moving averages. Now this is really important to note. Again, like we said, there's several days here where it tested the bottom side of the moving average. When you get a breakout like this, what you really want to see is a move up and then a pullback to the moving averages to test them from the top side and to have that test hold. And in this case, it did. So now on this day here, you get another nice spike up. Now, the problem with this day here and why I wouldn't buy it on that day, I'll show you here if we draw in some trend lines. The issue with that day is it's right at resistance. So our resistance area, if we were to use the tops of these candles, our resistance area is in between these two lines. So although this move up was really nice, the volume was pretty decent, maybe just slightly below average, but still pretty good. I wouldn't buy on this day because you're buying right at resistance. I would wait to see, again, how the stock reacts. So over the next 3 days, you see that, again, it's trading right within that resistance area. So at this point, you still don't know which way it's going to go. But the one thing to note that kind of makes me inclined to an upside move is, again, the moving averages. So this is how you use the moving averages to kind of tell you what the probability of a move is going to be. What's really nice about these moving averages is, like we mentioned, they were all touching in this area. And now that they're separating, you can see how clearly they're separating in order of time. So in other words, you have the 8-day, the 21-day, the 50-day, and the 200-day. When the moving averages are stacked in that order, it really indicates that you have a higher probability of the next move being up as opposed to being down. And that's exactly what we see happen the next day. So this candle here, this is your actual breakout. And if you look at the volume, you can see you get a big spike in volume. It's now, pretty significantly above the daily average volume. And you get a really strong close, a new high. So it's definitely a breakout. And the close is very high to the high of the day, which is important. So it closed strong for that particular day. This is definitely a day where either you could buy a full position if you haven't entered into it yet, or if you did buy a half position down here, this is the day where you buy your other half. And you can see if you were to buy there in a very short period of time, let's say even if you're buying towards the high of the day, you're up about 15% in a matter of a couple weeks. So that's how I like to use the moving averages, my favorite method for them. And let me just show you, if we scroll through this chart, we can find this exact pattern repeat over and over again. So this was the pattern we were looking at right over here. If we look at this one, we see the exact same thing. After this move up, the stock starts to consolidate. It pulls back a little bit, trades sideways. It does break below the 50, which is not ideal. You'd prefer for it to stay above the moving averages, but it's not really a big deal in this case. As you can see, we draw this trend line. We can see that several times the stock tried to break out and failed. So we draw that trend line. Here, let me zoom in just a little so it's easier to see. So we have our trend line, and again, we want to wait for some kind of confirmation of a move. So you definitely don't want to buy below the moving averages. I never buy a stock that's below moving averages trying to anticipate a move, because you could very easily end up with a move down. So you watch it and you wait for this breakout. Again, you can see the moving averages, look how close they get. So from this last move we looked at, you see you get this breakout, a rally of 15%, a pullback, and then what you really want to watch for is you can see how this 50-day moving average, how it continues to rise as the stock price trades sideways. And really what's happening is the price is waiting for the 50-day moving average to catch up. Once that 50-day moving average catches up and you have all these averages coiled again, that's when the stock is ready to enter its next high volatility move and continue its move up. And that's exactly what happens. So the 50-day catches up, the averages are all coiled, they're all still above the 200-day moving average. You get a breakout, and we can look at that breakout, look at the volume. The volume is above average. Again, it would be nicer if it was a little higher, but it is above average volume. That would be your buy point. And look at this nice rally that you get. If we continue scrolling across in time, we can see that we never get that same pattern over here. So if you were watching this stock and thinking, okay, well, it's doing the same thing again now. It's pulling back, starting to consolidate. We're going to get a bounce off this 50. Well, what you notice here is that these moving averages never really coil together. What you get instead is a pretty quick cross of the 8 and the 21 below the 50, and you never get that tightening pattern. So definitely using this method, there wouldn't have been any day on here where you could consider a possible entry, which is a good thing because, as you can see, the stock does pull back fairly hard after that break of the moving average. So continue on scrolling. We can see almost the exact same pattern developing here. Now, the reason I want to show this one is that it is slightly different. While this is a very similar pattern, it's not as ideal as the previous two that we looked at. And the issue with this one is that, for one thing, the moving averages are in the wrong order. You can see that, the 8, the 21, and the 50, they're all below the 200-day moving average now. So that is one, I wouldn't say you definitely cannot buy it, but it definitely is a warning sign. It definitely is something to be aware of if you're getting into a position like this. Now, the moving averages, they are getting really close together. They don't quite coil like how they did on the first two examples, but they are very close together. They are touching. So if I were to trade this setup, I definitely wouldn't go in as big as I would on the previous two setups. This setup can still work, and you can see in this case it did work out really well. If you were to buy this breakout, say even if you were a day late and bought it on this day here, I mean, that's a rise of 31% in about 27 trading days. So a really nice gain, but this type of setup is a little riskier, again, because the moving averages are not aligned the way they were in the previous two examples. So just something to be aware of. And then I think if we scroll ahead, yeah, we do get one more example. So what I'm trying to show you is that if you use this as your trading strategy or your trading method with these moving averages, it continuously repeats over and over and over again. It's not like you're only going to see this pattern every once in a while. I mean, if you scroll through any chart, you're going to see this pattern continue to repeat itself. And so here we have again, a big move in the stock. I think we said what was it, like 37%. And then the stock starts to consolidate, so it had this high volatility move. The moving averages, look how far apart, the 8-day is from the 50. big spread in the moving averages, period of high volatility, and then we start to get a consolidation and a period of low volatility. Again, the 50-day moving average catches up to the price. The moving averages are all coiled together. They're all above the 200-day moving average. And finally, we get a breakout on this day here and a really nice rally. And this one, if I remember correctly, yeah, this one turned out to be a really nice rally. So if you bought this, unfortunately, it would have been the first trading day of the year if you were watching it. But if you took this trade on the breakout, I mean, look how long this rally lasted. I mean, you could have held this. I mean, that's May. Looks like it's still going. Yeah, I mean, you could have held this, almost till June. So about a 6-month rally. And, even if you were a little late getting in, maybe say you didn't get in on this day here, but, after this breakout, you see this flag pattern and then a bounce off the 8, so let's say you got in somewhere around here. Obviously, you're not going to sell, you're not going to top take it, but, the top of this rally is almost 60%, so let's say even if you made, 50%, that's a really nice move. And again, this pattern is very reliable. It works with very high success, very high probability of success when you see the moving averages this tightly coiled, followed by a confirmation move, which that confirmation move is the breakout above a level of resistance. So again, that's my absolute favorite way to use the moving averages. Now, there is one more method I'll show you. Unfortunately for this one, I did have some trouble finding an example. And so this is the main reason why I don't use this method very often, only because it is a little bit harder to find examples of. It's not quite as reliable as the previous example we looked at, but it can still work. So I just wanted to throw this out there just so you have another option. The way this one works is, and so this actually, we're looking at an hourly chart of the S&P 500, so the SPY. This was actually the only place I was able to find this example easily. What you want to look for in this method is basically a pullback to a moving average, but have that moving average align with a horizontal level of either support or resistance. So let me explain what I mean by that. If we zoom into, well, let's say this area right here. So we can see that the stock is in a nice uptrend. It's making higher highs following the 8-day moving average. Then it starts to have a little pullback, consolidation. So here we get a test of the 50-period moving average. So again, remember, this is a 1-hour chart. So this line on here represents 50 hours. What we want to look for when we get a pullback like this is if we were to draw a support line or a horizontal line, has this area been prior resistance or support? So the way we would do that is by drawing a line across from this level. And what you can quickly see is that at the 50-day moving average, when you look back in time, that was previous resistance there, and it was previous support and resistance prior to that. So when you find an area like this, the reason this type of trade tends to work is there's two types of buyers here now, right? So remember we talked about a common misconception is that when a stock gets to a 50-day, people automatically buy. So when you have this pullback and when it's bouncing off the 50-day moving average, you get a lot of buyers coming in, buying the stock simply because it's bouncing off the 50-day. But in this case, the other thing you're getting is you're also getting buyers who are noticing this support level or this previous resistance level and are expecting a bounce off of that. So basically it's giving you, extra buyers coming into the market. You got both those that are trading resistance and support levels, and you have those that are trading moving averages. So it does usually work out. Again, I'll say it's not quite as reliable as the previous method that we looked at, but you can see here, if you were to look at this, if you saw this, this move to the 50-day and you notice that was prior resistance, so now you're banking on it being support, you do get a nice move up, and a pretty good rally before you finally start to lose some strength. So that's just another way to use the moving averages. Again, it's not my favorite, but I have used it in the past, and it is something just to keep an eye out for. So that's pretty much all I got for this video. Hopefully that gives you a better understanding of what moving averages are, how not to use them, and then a couple good ways where you could profit pretty nicely by incorporating moving averages into your strategy. So hopefully that was helpful. If you do enjoy this content, please hit the like and subscribe buttons. It really helps us out, and we'll see you on the next video.